Hi everyone, thank you for coming to this event. This is an event by Nomura's Market Update, as markets tomorrow, heads or tails, right? So before we begin, we would just like to share, like during these times of challenging period in COVID, FSM1 as well as Nomura Asset Management extends our thoughts to those who are facing challenges directly or indirectly posed by the outbreak, right? So before we start right now, I would just like to touch on a disclaimer in which as some of the things that we might be talking about in this webinar could be towards the wholesale side of things. So it might not be suitable for all investors. So if you are having any thoughts about it, you can go to our website or Nomura's website to find out more about it, right? So for those of you who have questions, please feel free to type into the chat box and we will address those questions as we go at the end of the session, and there will be a Q&A over there, right? So the speaker for today is Leslie Yap, Head of Investment of Nomura Asset Management, Malaysia. He oversees the developed markets equities portfolio management team in Kuala Lumpur, and the team also manages global equities of assets worth over 3.59 billion as of March 2020. Leslie have over 20 years of investment management experience, like since joining Nomura Asset Management in 2008. He has worked very closely with the firm's Tokyo as well as London offices, and he also is a member of multiple internal investment committees that deliberate and decide on investment frameworks as well as the allocations. Prior to joining Nomura Asset Management, he was an investment analyst based in Shanghai and Kuala Lumpur with companies including a GTJA Alliance Fund Management Company and Great Eastern Life Assurance. Last but not least, Leslie holds a bachelor's degree in engineering from the University of Nottingham, UK. He is also a CFA charter holder. So Leslie, I'll pass to you.
Hi, thanks, John. Thanks for the kind introduction. Good evening, everyone. As John mentioned, I hope that you're all doing well, all healthy and staying fine and safe, whether it's at office or at home. Thank you for your time, to join us today, to also listen into our webinar, and also, to share some of our thoughts on the markets. Before I continue, I just want to also highlight that our head of global equities, Mr. Tom Wagos, happened to be joining us online from London as well. So if you can see the screen, he's actually there.
Hi guys, hi everyone.
Yeah, he will also be hopefully sharing some of his thoughts and views later on in the presentation. So for some of you, we might have met because I've been speaking over the last couple of years at the FSM fairs, be it in Penang or in KL. But for this year, this is the first time because we didn't participate in early part, well, at least I didn't participate in early part of the year. So again, thank you for your time, and I'll start the session. And one last thing is, I hope you already had your dinner, because it's never good to listen about investment with an empty stomach. You won't be able to concentrate and take in the very important points that I'm going to share. Anyway, let's get moving. Okay, I think Sean gave us a bit of a background on the company. I'm just going to quickly run through it as well. If you can see from this slide, we are global. We're headquartered in Tokyo with offices across different countries around the globe. Asia, with Singapore as our main Asian hub, London as our main global hub. But we in Malaysia, we have a team that oversees global equities. We work very closely with our London team, and we report to Tom, who's on this presentation as well. I think you touched on the part about our AUM for global equities. You're right. I think we have gone closer to 4 billion ringgit by now for global equities managed from Malaysia. But overall, the group has about 440 billion US dollars under management. But in Malaysia, we're actually in our 13th year. And we have been actually running funds for the major pension funds in Malaysia. And we've also been winning awards running some of their funds for global equities, as well as domestic equities and fixed income. Okay, enough about us. Feel free to ask more if you want later on. Let's move on to the topic about global equity markets, and that's, I suppose, where your interest lies for tonight. Well, we're into June, literally end of June, end of first half. I have to say that it's been quite a year, quite an unexpected year. So let me just run through with you what happened at the start when we first moved from 2019 into the early part of this year. So if you look on the presentation with the yellow words, I think markets were generally, or investors were generally quite positive, especially having the phase one trade agreement between US and China achieved in December 2019. People were looking out for a cyclical recovery in the global economy held by China. In fact, I would personally was in China then in January before the whole COVID. Thankfully, I was safe. And we met a lot of companies, and people were saying that, in terms of production, in terms of inventory, they were rebuilding, they were reordering, prepare for a slightly better outlook than 2019, given what was going on with the trade. So people and investors generally positive. And I don't know whether you remember what happened after New Year's Day, or anyone still care and bothered. Remember a Iranian general that was killed when US bombed Iraq? Well, the markets only reacted for a day, and after that, basically just continued to move up. People ignored it. We talked about impeachment for Trump. Again, markets ignored it. Not until before Chinese New Year, where the whole development in China on the whole coronavirus and COVID-19 began to worsen, and then it started to spread across the globe, that markets reacted in late February. So a quick recap, I know you all know this if you're investing. Markets tumbled, borders closed, economies closed, and we saw using this chart, which is the MSCI All World, the index falling 35% in a matter of a month. In 1 month, 35% down. That was a very, very sharp correction. But before we knew it, and we were still trying to understand what was going on, this time around, central bankers came in, moved rapidly, learned from their experience in global financial crisis back in 2009. They cut rates very sharply, provided huge amount of monetary and fiscal stimulus, supported fixed income markets, provide backstop to the whole financial meltdown. Equity markets felt a bit more comfortable, and we sort of started to rebound very quickly, followed by news of potential vaccine and cure. And then eventually we saw markets and economies gradually reopening. And today, we're back up 36% from the bottom. Not quite back to the top, but very good returns if you have bought at the bottom. So that's a quick summary of the first half of this year. Now, moving on, where we are today. So all that in the past, if I may, just highlight a few things. In terms of the global economy, things are definitely recovering. So, as I mentioned just now, central banks has been supporting the global economy by, basically expanding balance sheets to historical highs, even way beyond what they did in global financial crisis. That was the backstop to global economy and markets. What we have seen so far with the developed markets, manufacturing output using PMI as a gauge, if you see the red so-called circle here, things have actually rebounded on a V shape, even though it's still below 50, but very close to expansionary levels again. In terms of consumers, that's also very key for developed markets. Some data to show you here. Total card spending has already, in the blue line for 2020, suffered, but has also come back and to levels close to 2019. And one more chart on consumer spending, ex-autos, in fact, has shown that consumption has moved on beyond 2019 levels. So all in all, pretty good in terms of general macro data post central bank support. But as usual, we never, we don't only get good news. There's always risk concerns. Every day, the newspaper will be talking about something new, some new challenges. And the latest being the concern that markets have opened, economies have opened, that we may experience a second wave of infection, especially coming out from the US. So if you look at the charts available here, no doubt you see and read about places like new hotspots in Arizona, Texas, Florida, and the US, whereby new cases or new infection cases have spiked sharply in the recent weeks. However, I will run through with you the next couple of slides just to give you a bit more detail, so we have a bit of clarity on what's actually going on the ground. So however, we talked about Arizona, Texas, but there are also other old hotspots in the blue line on the top left chart that shows that things continue to come off. So places like New Jersey, New York, Massachusetts, Washington, things are actually coming down, whereas the rest of America is more like flattening. What is also important, or at least in the meantime, comforting, is that despite a spike in the new cases, the new deaths per day on the 7-day average hasn't really increased. In fact, it's been trending down. Now, we don't want to be too positive just yet, because as usual, with new cases, it might take a week or two before the new infection gets more serious that could lead to death. So we are watching this number very closely, and if things picked up, then we'll be a bit more concerned, especially on the new death. The other data point that we picked up, also very interesting, and might give investors a bit more comfort about continuing to invest and not being too worried, is that in these new cases, then by age group, the number of people who are above 50 years old have actually come off quite sharply. Percentage-wise, is actually halved. So what it means is new testing, a lot more young people within the new infection cases. What that tells me is that potentially, and I say potentially, I'm not a doctor, but potentially young people, as we know from previous death and reports on death, normally it affects more of the older generation. If you're young, you tend to be healthier. You might be sick, you might be affected, but you won't be facing potential more fatal consequences. And the other news that always comes up, and media likes to talk about it, newspaper like to report, is that ICU beds are full. In cities, we could face another round of challenge. The system cannot handle the patients. But again, digging down deeper into the data, I just want to share with you in this bottom right-hand chart is hospital beds in this so-called new hotspots. If you can see the bar on the far left, AZ, which highlights Arizona, the percentage of hospital beds occupied by COVID-19 is only 15%. Now, no doubt the 15% is increasing by the day, but you hear reports talking about ICU beds already 85% near to maximum. But a lot of the beds were actually occupied by people who previously couldn't get their operations or couldn't see doctor because, basically because there was the hospitals were all busy with COVID and they couldn't do anything. Now that hospitals have reopened, people went back and they need ICU care after operation. So, just to put things into perspective, Arizona hotspot, 15% of the hospital beds are actually because of COVID-19 and not 85%. So we are careful. We want to be, don't want to be too optimistic. We'll be watching this space closely. The other headwind, or what people normally talk about in terms of global markets, is, well, markets have rebounded sharply. Economy has actually slowed, no doubt. And, earnings and, the valuations of stocks must be very expensive because we are moved up. I would say yes and no. If you look at the pure, basic, simple PE multiples of, let's say, S&P 500 as a gauge, on the left chart, top left chart, sorry, it's the left chart, you can see that it's going back above 1 standard deviation historically. No one really follows 2020 earnings because everyone has already written off 2020. When people start looking at 2021, there's a whole range because no one can have a certainty in terms of how to forecast. So we've seen earnings of the S&P 500 being talked about $140 to $160. Now that's about 20 times current market multiples. Is that expensive? Well, yes, if you compare just purely on historical PEs. But if I may just also put this out to you, with interest rate close to zero and with 10-year treasury, yielding 0.65%, one could also argue that global equities aren't really that expensive because such low yields, what else do you have to generate your returns? Where else can you go to put your money? All right. And on the right-hand chart, if you look closely, let me expand that. Yeah. This gives you a sense. This is the yield gap. I just want to focus on the dark blue line, which is the yield gap. Yield gap basically is taking the earnings over inverse of PE, earnings over the market cap of the S&P 500 and minus the 10-year US Treasury. And you can see that it is actually trading above historical average. So, and if I may simplify that point, you have Treasury giving you 0.65% return, or you invest equities, which is yielding 5% return. Of course, equities will always have higher risk, but the difference between the 5% and 0.65%, I think it's not too bad for investors to take in terms of risk. Okay, but what people like to say nowadays, there is no alternative. So you might have to continue to look for equities as a way to invest and generate your returns. The other point that I also want to share, which I think will help frame our thoughts for the medium term, is that why we are not necessarily too bearish, is that there is ample liquidity in the market and also investors positioning. On the left-hand chart, you can see that money market funds in the US, basically like cash funds, are basically earning almost zero. But yet, given the crisis, the amount that have flowed into money market funds shot up to new highs, crazy levels of $4.5 trillion. Okay, and these money are earning close to nothing. I don't know about you putting your money in a bank that gives you, let's say, 0% interest. How long would you keep your money in the bank? Right? Maybe 1 month because you're not comfortable, but for 6 months, for a year. And the interesting point is that things have already started to change. You saw the tick down in the funds level towards June, which tells me that people are already starting to move money out of money market funds. Now, where are they going? Maybe fixed income, but what about equities? That brings me to the right-hand chart. Oops, sorry. Which is this is a Bank of America Merrill Lynch data that highlights that their private clients have been buying equities. So in late June, they are showing that they are moving money into equities again for the first time after 11 weeks of negative equity flows. So it sort of matches with the left-hand chart whereby money market funds are coming down, but only beginning, and investors are putting money in. Why is this supportive? Basically, all I need is for this left-hand chart for the tick to continue to move down. I don't need it to go all the way back down, but even if they move down to only 4 trillion, that means 500 billion of money moving back into, well, riskier assets, put it that way, be it equities, fixed income, or bonds. And that's supportive of the stock market. And to your point about what about healthcare risks, you talked about all the new infections. Aren't people worried? Yes, people are worried, but markets always look to the future because they discount the future. And what we are seeing is in the coming months, at least June, July into year end, we will hear and see more and more news of be it drugs or vaccine being tested, being eventually manufactured to help cure or prevent the disease. And companies, I won't go to the details, and don't bother if the screen is too small and the names are too small. You hear it all the time. This is just an example of a list of companies being supported by government, private entities, pushing in a lot of funds to find the right vaccine and the right cure for these diseases. And the moment market picks up news on a potential drug or potential vaccine being successful, markets do react positively to it. And we have seen it over the last month or so as well. Whenever a company come out and say that, they are in phase 2 or phase 3 or of the test, or they're expediting the whole process, investors take that positively. So I believe in human ingenuity, and I believe that one day, hopefully sooner, we'll find a cure and a vaccine. So I don't want to be, not invested when that happens. Now, that's what I have in terms of some of the current debate on the market. So you said, well, Leslie, great, you tell me all this. I read some of that, some of them new to me. So how do I navigate through this? And maybe perhaps I will take you first back in history to help frame the future. If you remember at the start, I said I used to present at some of these fund supermarket fairs. And also I want to take this opportunity to maybe do a bit of a review on some of our calls back then. And that sort of leads to what we would like to share with you on our views on the market. So the last time we spoke, both myself and Tom, it was back in January 2019 at the fair. And this was, if you attended and you were there, hopefully you remember. If not, that was our title. Don't let your emotions invest for you. January 2019, more than a year and a half ago. What happened then? What are some of our slides, and what are some of the topics that were of interest? US-China trade war from 2018. People were worried about Brexit, don't know how that's going to pan out. I share with you this chart highlighting that, looking into 2019, there are so many events that could present risk to markets. How are you going to handle all this? But what was our conclusion at the end of the presentation back in January 2019? We told you guys or other investors basically, look, just keep calm and stay rational. And why I'm sharing you this is because if you had followed the advice, let's see what happened. So if you have stayed calm, rational, and continued to stay invested, then back in January, I put 2019, and you invested in global equity markets, the MSCI would have given you, I think, 6.7% returns for 1.5 years. Not too bad, positive returns. But I'm sorry, I have to do a bit of marketing for Nomura here. If you have invested with our funds, you would have generated 19.5% return. I would think that's a very good return over a year and a half. So why am I saying that, and what should we do? And some ideas. We are sticking as a house as to our investment process and how we share with investors. We say that given all the points that I've shared earlier on about the headwinds, the challenges, also what could support the market, we think investors generally should stay positive, stick to your process in terms of, when I say process, what you know and what you understand best. Okay. If there are pullbacks, we don't think that markets will pull back with like another round of a 35% drop. Perhaps some sort of I'm just roughly taking a number of, let's say 5-10%, would be very interesting for you if you still have cash to put some money in. Or thirdly, let's keep it simple. We like that word simple, and just invest with Nomura through our funds. So before I continue, I want to share with you this motto that I have, and I hope that you can remember this. Basically, 3 words: less is more. Okay, so keep things simple and remember, less is more. I'll explain further what I mean by that. So to the point about keeping things simple, I want to share with you our thinking and our process, especially for investors like yourself. I think the key point is to start off, investment should be made as simple as possible. Why? If you do not understand and if things get too complicated, chances are that it's too good to be true. Okay, so we think that being transparent, whatever you invest in, and you can easily understand it, that will make your life easier and they'll give you a better chance of making a positive return. So simple. Next, choosing the essentials. Essentials basically meaning what's important for your portfolio. And I think being careful, selecting quality companies to invest is essential. All right. Do not try to risk by taking companies or weak companies. Quality companies will more or less guarantee you positive returns over time. And to the point about less is more, why I say that? I'll give you an example. If I can share and send a message to you in 10 words, would you want to listen to me talking or telling you the story in 100 words? Probably not. If I can give you a portfolio of 20 stocks that you really understand and you can follow it closely, give you the return and diversify your risk, wouldn't you not prefer a 20 stock portfolio? Would you prefer a 100 stock portfolio when you invest because you have no time to understand everything you are investing in? Or maybe even the fund manager themselves, if they're running a, let's say 50, 60 or 80 stock portfolio, they wouldn't have time to monitor everything closely. What if there's a fund manager that can give you with 20 stocks, they know everything about the companies and the stock, they give you the returns and they diversify the risk for you, all right? So choosing that fund manager as the last point here is very important. Choose the right manager because you are paying management fees to the fund manager and the fees are meant to pay for their alpha generation, basically excess return over the benchmark. Okay, so that's what I mean when I said simplify, less is more. That brings to next. I'll give you a bit more detail on the few key points just now I highlighted. So number one, on quality, why is important to choose quality? I think the track record speaks for itself. This is a chart I want to share with you where it shows the MSCI World Quality Index rebase is compared to the MSCI World Index. And you can see over time, with the exception of 1980s, all the way from 1989, 1990, all the way to now, the MSCI World Quality Index has outperformed the overall benchmark of MSCI World. So always good to stick with quality. Number two, simplifying and understanding your portfolio. So just now I said the example of a portfolio manager who can give you the returns with only 20 stocks and diversify your risk. Okay, the number 20 did not just simply appear. It wasn't because I felt good today and I looked at maybe my house number and it's 20 and I just threw out the number 20. The fact is that our team in UK, led by Tom, we actually constructed multiple portfolios of different stock counts from 10, 50, or even 100 or more. And looking through the period of 2004 and 2015, and we tested it, and we found that the portfolio risk improves as you increase the number of stocks, obviously. From 1, 2, 3 onwards, the portfolio risk comes off. But the moment you hit 20 stocks, the incremental risk that you actually diversify is reduced. Basically, the more you put in, you don't get as much diversification as you think or you would expect. So 20 stocks is optimum. So this has been tested. We have a white paper on this. If you're really interested, you can go onto our website, or if you can't find it, do let us know. We are happy to share with you on this study. So quality, number 2, simplify. Lastly, I talked about a fund manager and a right manager who could give you the alpha. So a fund should be able to position to capitalize on the right stock. Fund managers justify their fees, right? What if a fund can perform for you in rising and falling markets? Ideally, that's great, because when markets fall, you outperform on the way down, And on the way up, when markets rebound, you actually do better than the market. That's what you should look for. And also a fund that, because of the low number of stocks, it has a very low turnover. That keeps transaction costs low as well. So if there's a portfolio that has a portfolio turnover of about 25 to 35% a year, I think that's pretty good. And if you can see the table on the right, that's what at Nomura we have at the moment on the FSM platform. It's one of our key funds. It's a global fund. As you can see from the track record on a 1 year, 3 year, and since launch, these are great markets, great time to be investing because the benchmark was positive. We actually outperformed the benchmark. But also to share with you, year to date in end of May, using end May numbers, given that was the last month of the performance data, benchmark was down 4.22%, but yet this fund managed to generate about 1.3% of positive return. So to the point about fund outperforming on the way down, as well as also on the way up. Okay. So on this fund, you might hopefully the numbers have gotten you a bit excited. But you ask, okay, what's in this fund? For those who are not familiar, so in this fund we capture some of the more circular investment themes out there, but we focus more on the companies. We do bottom-up research. Areas that we are invested in are things like global payments. Obviously, cash. Not before COVID, cashless payment is already growing. Now there's actually moving faster. So there's a lot of room for payments to grow, cashless payment to grow. We are invested in that space. Obviously, healthcare, it's obvious. Aging population. With COVID, people are more health conscious. With the advent of robotic in healthcare, these are also happening. We are invested in that space. And technology, cloud computing, data centers, we are benefiting because the fund is also invested in this space. And naturally, consumer trends or new consumer trends globally, a rising middle income population in emerging markets, very powerful, both not only for consumer trends, but also in financial services. As middle income grow, they also require more financial services. We actually capture some of these. We have stocks that fall under these sort of themes for the fund. So I don't know about you, and for me, I think these themes are pretty exciting, especially if you look to the future. So with that, I think I'm coming close to the end of the presentation. I just want to, again, remind that investors that perhaps you should not be too worried. Definitely watch the markets, be careful, but don't have zero investment, stay invested. The message is also simplify your investment. Invest in something that it's easy to understand, that and also trust in a fund manager that can deliver you the returns and have a good track record. So we believe at Nomura, especially with this Nomura Global High Conviction Fund, we can meet your investment needs. That's myself on the left, and also Tom on the right. That's our background. And with that, I'll leave you with the last slide. So this is the details of the fund that we highlighted throughout the presentation. I also want to remind and also to share that, very important, the track record and the numbers we showed just now are already net of fees. So this is literally what you get. It's already taken all the fees and all the fund expenses out, because that's NAV of the fund. Not only that, I think at the moment we have also adjusted the minimum initial investment recently from 10,000 down to 5,000 ringgit. So that's all you need to start investing. Some details of the fund in terms of our exposure globally, and also some top 5 holdings of the stocks for this particular fund. So with that, I think I've spoken for quite some time. I'll stop here and I'll get Tom to join in. And Sean, I don't know how you want to proceed, whether we can start Q&A.
Sure. Let's begin the Q&A. So there's a couple of questions over here. So the first one is what are some of the sectors that you prefer, as well as maybe you could perhaps highlight what are the possible risks towards those sectors?
Okay, I'll touch on a few first. Before this slide, I think you can see that these are some of the very powerful trends that are happening around the world, from cashless payments, like I said. So we have we are investors in MasterCard, we are investors in PayPal. Those are names that are in the top 5 slides. So I'm happy, or Tom will be happy to share more with you. Healthcare, definitely. And in technology space, the cloud computing, AI, those are very powerful trends that the funds are invested in. And when you say risk, I think in every sector and in every business that I'm not trying to give you a very generic reply, but because these are so powerful and circular, that even there might be short-term risks, the business will continue to grow and will continue to generate very strong ROE and ROIC. And that's the sort of, again, back to the point about quality companies that we invest in. So even though there are short-term risks, they should be able to continue to grow and deliver returns to shareholders. So I don't know whether that sort of touch on the question you have, Sean, in terms of sectors and risk. Maybe I'll also open it to Tom.
Yeah, sure. My first thing I'd say is you take a step back. It's not so much sectors and regions, it's types of companies. And as importantly, valuation. So, we have a very clear definition or understanding of what makes a quality company. The easiest way to think about it is return on invested capital. There are other things as well, and we spend a lot of time thinking about valuation. Then, which sectors fit that? Which sectors tend to generate above cost of capital returns? And things like healthcare, things like technology tend to turn out to be, in that group. Some industrial companies as well, really fantastic returns on capital in there. The less good, things like materials, energy, and so on. Energy probably among the worst. The returns that those companies generate tend to be quite poor. And I'm not talking about now because the oil price has fallen. I'm talking about over many years, decades. If you look at even the best known oil companies, BP, Shell, ExxonMobil, they all generate close to cost of capital versus something like a MasterCard, which is generating 40% returns on capital. So that's the thing I would say there. And so that's the kind of framework I'd have in my mind when thinking about sectors. If you want to play, or try and take a very short-term view, then that's different. But we're taking a long-term view. Similar case for regions as well. We actually find lots of good quality companies in the US. They tend to have a more shareholder-friendly approach to business, and so that tends to be why US domiciled companies or US managed companies show up to a large extent in our investment or in our funds. Actually, the economic exposure, the US companies, like several companies with revenues generated all over the world, they just happen to be based in the US and have that, I suppose, capitalist mindset, which ultimately has generated good returns over a long time.
So there's another question in regards to the US. So given that the fund already has quite a high exposure towards the US market, and Leslie has also touched a little bit on in terms of the valuations of the US market. Would Nomura be perhaps considering taking some profits off the table and maybe like shifting some percentage towards perhaps the emerging market, for example?
Yeah, it's a good question. I mean, I guess you're looking at the you're looking at the pie chart there. I just touched on it a second ago. Yeah, there's US domiciled companies there, but a lot of that, the revenue generated by those companies is generated around the world. So, you know, even companies which on the face of it seem to be quite US centric, let's say take A.O. Smith, which makes water heaters, 30% of that business is Chinese. So already has quite an exposure to emerging markets. So these kind of domicile-oriented charts can be quite misleading. And the other way of looking at it is if you try to pick a US fund or an S&P 500 fund as a way to try and, let's in inverted commas, play an exposure to the US, actually a lot of the companies that appear in that index are not just US companies. It's much more the case in smaller cap, of course, but typically a lot of these funds own large cap stocks or very large companies. And so actually the exposure of our fund is much more diversified around the world than it first appears.
Right. Previously, you have mentioned that, like, to advise investors to purchase during the dips. Is there any color you can give towards our audience in terms of how do they go about this? For example, do they split it into 3 parts and invest it every 2 weeks or 1 month, or do they invest based on percentage? Maybe you can touch a little bit on this.
Well, I mean, this is sort of getting away from specific equity investment. So I don't want to particularly give advice on each individual investment approach. It rather depends on your personal circumstances, the rate at which or how the cash you have is coming. Is it coming per month, per week, or do you just have a large pot available to invest right now? Certainly from our perspective, it's much more along the lines of we have a large pot of money to invest right now, what should we do? And so here we focus on valuation. So we're very clear on what we think each stock is worth. If and when it gets up to that level, we'll start to sell and hold cash. And if the prices go down below that level, then we'll start to buy. And so an easy example, was earlier this year, we had by the end of February about 8% cash in the fund, which is quite high. There's no market call there. See, we had no idea that a global pandemic was about to start. But what we did know is that the stocks that we were holding and looking at seemed to be trading pretty close to what we thought they were worth, and so we should start selling. So we did. Then obviously the market started falling, and we just bought a bit every day. We had no idea, how low it was going to go, or all that stuff. You could see by the end that the market was clearly in panic mode. We had those down days of 10% down and things like that, which is really crazy when you think about what that really means in terms of the companies that, say, MasterCard is suddenly worth 10%, make a huge amount of common sense. So we were just buying and buying and buying. So by the end of March, we'd invested all of our money, all of the cash, so essentially 0% cash. Of course, then the market recovered. It happened to recover from around about I think it was the 23rd of March. We had no particular call on that, but we felt these valuations are too attractive to turn down. And that's the way I would look at it, valuation.
Thanks, Tom. In light of our limited time, maybe I'll just touch on just the last question. Could you maybe perhaps share what is your outlook on the USD, maybe perhaps on a short-term as well as a long-term basis?
Well, we're not currency strategists, so it's a tough one, actually. I mean, clearly you're seeing the Federal Reserve printing a lot of money, not physically, but notionally printing a lot of money, which by its definition is devaluing the currency. It must be. But on the other hand, lots of other countries around the world are doing the same thing. So everyone is devaluing their money. which in that sense you should think that leads to inflation. But my hesitation there is this is exactly the same playbook we saw at the financial crisis. People saw assumed that would lead to inflation, so gold price went up a lot. Actually, inflation didn't come, and then the gold price collapsed. And that's very potentially the same thing we see now. And so we need to have that in the back of your mind. You could look at Japan as well. I mean, they've done a lot of unconventional monetary policy over the years to try and get out of that inflation trap they're in. Of monetary, so I would have that in the back of your mind. As for the US dollar, one thing that always strikes me, and it certainly strikes me post-financial crisis, is the flexibility and resilience of the US economy. It actually tends to surprise on the upside, I think. There were plenty of people 10 years ago writing the US off, saying, hey, it's over for these guys. Financial crisis is, it was sort of end of an empire type moment for the US, but it just hasn't happened. China's catching up. That's fine, but you can even look at China and say, well, hang on a minute, it's a company probably economically would be way ahead of the US already if it hadn't been for the government policies of even going back to the 50s, 60s, the Cultural Revolution and Great Leap Forward and all that kind of stuff really hampered the Chinese development, which is why China is now in a kind of a catch-up mode. Technologically, the US remains the leader. And so with that in mind, you start to think, is the US dollar likely to collapse anytime soon? It's possible given the monetary policies, but those policies have been matched by other countries around the world. The US has tended to remain quite a flexible and strong economy. It's difficult to imagine it happening, to be honest, but it's possible. But again, this is really outside of our normal way of thinking. We're not currency strategists. We don't really take a view there.
Right, thanks. I think we'll end it for today. But we realize that we won't be able to answer all the questions that is coming in right now. But for those who are still having some questions, please feel free to email research.my@fundsupermart.com, and we'll gladly take on those answers. So I think that's the end for our market update for today by Nomura. That's all for today.
Yeah, thanks, Sean. Thanks everyone for listening in.
Thank you
very much.
Right. Thank you. Grateful. Thank you.
Bye.